Welcome to Subramani. When should you sell your mutual fund? Right, this is the question which I'm going to try to answer today. This is slightly different from when should you sell a particular share. In most cases, for many of us, largely there is nothing called selling a share. It is switching of a share. You sell A to buy B, you sell B to buy C, or something like that. Similarly, in the mutual fund also that can happen, and that can happen because of many reasons. So let us look at the reasons. Not it's just coming offhand. I've written down something, but largely coming offhand, so it's not exactly in the order in which there's no importance, right? If the reason number 10 could have been reason number 1, so I'm not saying this is any particular order. But first one is consistent underperformance of the benchmark. What happens is, in a public place, when a manager is managing, he is going to be judged on a relative performance. Now, if I were to go to one individual and say, here is my money, manage it, and I want 12% return, then I'm looking for absolute return. Unfortunately or fortunately, in case of a mutual fund, we are looking for relative return. So every fund has a benchmark, and if he's underperforming, or if she is underperforming the index by a mile consistently, which means over 2-3 years or 5 quarters, 6 quarters, whatever you want to look at, then you should be selling off the fund, right? So that's very important. Saying if you're consistently underperforming, maybe it's a large cap space in which you are talking about, and they're underperforming the index, there is absolutely no reason to pay extra fees and have underperformance. You might as well go to an index fund. So there is only one problem, that in India the SEBI insists that everybody should have a benchmark. So if the benchmark itself is not appropriate, then you may rethink, you may look at the portfolio, you may look for some other parameters, you may not look at this. But normally in 99% of the cases, if it is underperforming the benchmark, if it is underperforming the peers for a long period of time, it's a great time to be existing, right? Second is when you think that that asset class is bloated. For example, you have put money in equity, 1 rupee has become 5 rupees or 4 rupees or whatever, it's bloated too much, and you are not comfortable with the valuation. Right now, I may not be comfortable with small cap valuation, I may not be comfortable with mid cap valuation, I may not be comfortable with large cap valuation, whatever. Whichever place I'm not happy with the valuation, maybe I'm not happy with the valuation space in banking, in pharma or anything, that is a great time to come out of that fund. So if you are in a pharma fund and you think that the market is or the pharma fund is outperformed, you've got something like 36% return over the last 6-7 years CAGR, you think this can't be maintained, that's your view. Taking some money out of it or taking all the money out of it is perfectly possible. In my case, in a pharma fund, I'm just putting money in a pharma fund which is enough to pay my hospital bill in case there is a shortfall from the insurance. And today my pharma fund is bloated. I got so much money in my pharma fund that I don't need my insurance, right? So just kidding. So that is a good reason that that asset class is bloated. Could be a specific place like a banking fund or a pharma fund or equities in general. You think it is bloated, you think it's not worth it. Therefore, in your overall asset allocation, it looks like equity is now 75%, 80%, and you are retired. That's a great reason to come out of a equity fund and go into a debt fund. Today, of course, the choice is available that you can put into multi-asset fund. When the fund manager himself sells equity and puts it into debt, or sells debt in equity, buys gold, or sells gold and buys equity, it is more tax efficient. So let the fund manager do the asset allocation rather than you doing the asset allocation. That's another. He'll also do it more scientifically on the basis of some team effort rather than you singly trying to do it yourself. If a large cap fund is just like a index fund, it is a close-setted index fund. It just keeps doing whatever there in the index. 30% of the index is one particular item, which can't happen in a large cap, but maybe something like that, and he's very closely copying the index. You might as well go to the index, it's much cheaper. Why pay extra management fee for underperformance and just closeted funds? So be aware, if it is a closeted fund, if it is copying the index too much or hugging the index too much, it's a good enough reason to sell. Another thing is availability of cheaper options. This happens more in the US, where they look at a good fund and they just copy the fund, right? They just copy the bigger fund at a cheaper rate. Can you consistently do it? I think I can consistently do a copy of Warren Buffett portfolio and offer it at a lesser fee, right? Of course, Buffett doesn't charge fees. That's a different matter altogether. So something like that, if cheaper options are available, or if you think a younger fund manager is doing better value oriented funds than some of the older fund managers who are charging a bigger premium, that's good enough reason to come out. For me, another big reason to come out is the fund manager's retirement. Prashant Jain retired, and I was consistently watching, or rather I was watching how the handover went, and I think the handover was very good, and the fund performance has not slipped after Prashant Jain left. So similarly, in 2-3 years we will see Naren leaving ICICI Prudential. So I'll have to rethink on the strategy on the funds in which he is there, right? So fund manager change is a very important thing to monitor. For me, it's very important. For many people, it's not important. They think the system will take care. Well, system can't really replace a Naren or a Prashant Jain, but yes, it is possible. So another thing is, the markets have done too well. You want to get off the roller coaster because it's just going too fast, right? Or it's going too high and staying there for too long, and you are now near the bottom and you say, let me get out. I know I can get out now, and with a lot of my money intact. So taking a big chunk out of it, or taking a small chunk out of it and putting it to less fluctuating, I wouldn't say less risky, less fluctuating things like a debt fund or a gold or a multi-asset fund or something like that. So reallocating, that's a good reason for you to sell off the bloated asset, whichever is the bloated asset, selling that off. So shifting to different financial modules, like you want to get into debt funds, you want to get into debt assets like bank deposits, etc. That may be a good enough reason. Another important reason could be you have reached your goal. Suppose you wanted to buy a house, and house prices have come down and the value of the fund has gone up, and you realize that buying a house today, because you've decided to buy a house, not because you want to live in that house, you want to buy a bigger house or something like that, your objective is very near. Even let's say we are in 2024 and you want to pay for your daughter's school fees or college fees, higher education fees in 2026, it's a fantastic reason to remove money in 2024, or start doing a systematic withdrawal plan for the event, saying if the event is in 2026 and I need 36 lakhs and I have 18 months to go, I'll withdraw 2 lakhs every month, or maybe I'll withdraw 7-8 lakhs in one shot and then start withdrawing 2 lakhs every month, because in case the market falls for whatever reasons, you should not be found short. Of course, if you have some more money in debt fund which you can use in case of a worst case scenario, that's a different thing. But removing money and putting it into an ultra short bond fund as a systematic withdrawal makes sense. Also, one important reason to remove money from a debt fund, let's say interest rates are now 7% and then it goes to 6, 5 and 4, and you now think, I'm talking of gilt rates, so it is now say 7%, it is slightly less, and you think interest rates will go down, good call. Then if it goes from 7 to 6 to 5 to 4, at 4 you realize that all the portfolio value increase in the fund has already been got, because you have fully ridden the the change in interest rates contributing to your profits, right? So the value of your debt fund has gone up dramatically. This can happen even in debt, like it can happen in equity. That is the reason when you should get out. Either you get out fully, get out 70-80%, leave 20% there, or you get out 100%, because interest rates cannot fall further. The coupon being low, the returns are going to be not to be too great, so leave only that much amount in debt, or that too in ultra short bond fund kind of a thing, or a short bond fund, saying as and when the interest rates go up, I can always move money from equity to debt. Right now it's a good time, where I'm shooting this in August 24. It's a good time to be staying in gilt. I'm making very good money today in the gilt fund. But when interest rates go down, which it will, that would be a time to get out of it. So when the debt funds are doing well, you may to get out of debt. When the equity funds are doing well, you may partially get out of that. When a fund changes its objectives, so fund is a mid-cap fund, then it says, okay, we are changing from mid-cap to mid and large cap because we don't get enough opportunities in mid-cap. You may think twice about what to do, and you may move from mid cap to large cap, or something like that. So that can also happen. The reverse can also happen. You get from large cap to mid cap, or you go from large cap to a multi cap fund, saying okay, it will have some large cap, some mid cap and small cap also, right? So that kind of a thing you can do. Or you go from a large cap to a multi asset, saying okay, little bit of gold, little bit of debt, little bit of equity, I get all of this. Or maybe there is a fund which is investing in foreign equity. So to go into any of these schemes also, you might just go. What happens when there is a merger or a demerger? I know one fund house, I am not naming them, horribly managed debt funds, and they have done badly, but they just keep merging some of their funds, and you don't even know what's happening. I just stay away from such a fund house, even from equity. So some of these things do happen, so you stay away from such funds. So when they are merging, demerging, or whatever, or there's a fund manager change or a fund objective change, these are all good reasons for you to change your or sell your mutual fund. Sometimes when a fund is not doing well and there is a loss, you may want to book capital loss, right? So you may want to book capital loss, and that could be enough reason to sell. So you book your capital loss and you take your what is called the loss harvesting, right? So you do a tax loss harvesting. That's enough reason. I think there'll be more reasons, but to me this is good enough, in the sense that I can't think of more reasons now. I may make another video later on. Thank you.